In the last episode, we worked through the 4 questions that expose the structural flaws in conventional investing, the assumptions about surplus income, available time, sufficient returns, and realistic retirement estimates that most people have never examined carefully. If you haven't watched that episode, I'd suggest starting there because this one builds directly on it. We ended with a preview. The answer to those structural problems is the 3-engine wealth system. And today, we build out the complete framework. By the end of this episode, you will understand how the system works, what each engine does, and why the 3 of them together produce results that no single engine could produce alone. Now, let me start with what I think is the most important conceptual shift in this entire series. It's the difference between thinking of your investments as a collection and thinking of them as a system. Most investors think in terms of a collection. They have some exchange-traded funds, maybe a few individual stocks, maybe a retirement account with a mix of funds, savings accounts sitting on the side. These things all exist in parallel. They don't interact with each other in any deliberate way. When the investor adds money, they add it to whichever account just seems most appropriate at the time. When they need to review things, they look at each one individually. The portfolio is the sum of its parts and nothing more. But a system is different. A system has components with defined roles. The output of one component becomes the input of the next. The components are interdependent. They're designed to work together, not just to coexist. And a well-designed system produces results that are greater than the sum of its parts, because the interactions between components create something that no single component could generate on its own. The 3-engine wealth system is built on exactly this logic. Each engine has a specific job. Each engine produces an output that the next engine depends on. And the whole system, running together, accelerates wealth building in a way that is fundamentally different from a collection of disconnected investments sitting in separate accounts. So this is the architecture. 3 engines arranged in sequence with capital flowing deliberately between them. The engines don't just coexist. Each one produces an output that the next one depends on to function at full capacity. Now, understanding that dependency is the key to understanding why the system works the way it does. Let me take each engine in turn and explain what it does, why it matters, and how it fits into the larger picture. The first engine is the income engine. Its job is to generate reliable, recurring cash flow through active participation in the markets. It's not appreciation, it's income, and there's an important distinction there. Appreciation is what happens when the value of something you own goes up. For example, you buy a stock at $50, it rises to $70, and you have made $20 of appreciation. But you haven't actually made anything until you sell it. And while you're holding it, you have no new cash to put to work elsewhere. Appreciation is passive. It happens to you, or it doesn't, and you have limited control over when or whether it materializes. Now, income is a different beast. Income is cash that arrives in your account as a direct result of something you did. A trade you placed and closed, a premium you collected by selling an options contract. It might be a dividend paid on a position that you structured specifically to receive it. Income is active. It's generated by a deliberate process. And because it arrives as cash, it's immediately available to do the next thing, to be reinvested, to be reallocated, to be deployed into one of the other engines. This distinction matters enormously for the system because the income engine is the fuel source. Without it, the other engines have nothing additional to run on. They can compound what's already there, but they can't accelerate. They can't bring in new capital at a pace that meaningfully changes the trajectory. The income engine is what changes the trajectory. Now, what does the income engine actually involve in practice? Well, that depends on you. The defining characteristic is not the instrument, it's the outcome. The income engine should generate cash reliably on a monthly basis. How you generate that cash is a function of your skills, your schedule, your capital, and the mentors that you choose to work with. Some people will run the income engine through active stock trading, buying and selling equities on a short-term basis to capture price movements. Others will use option strategies that generate premium from positions that don't necessarily require constant monitoring. Others will use futures contracts, and these offer significant leverage and the ability to generate meaningful returns from a relatively small account size. Others still might use Forex or a combination of approaches that evolves as their skills develop. The system does not prescribe which of these you choose. What it prescribes is the role. The income engine generates monthly cash flow. The method that achieves that role reliably, sustainably, and in a way that fits your actual life, well, that's the right method for you. Now, in the $1 Million Experiment, which is our live 5-year implementation of this system, we've chosen to use Micro E-mini S&P 500 futures contracts as the primary income engine instrument. Now, we started with a $3,000 account. Our monthly income target is $249, which represents an 8.3% monthly return on that starting capital. Now, we chose this approach because of the leverage available and the near 24 hours. It's actually open 23 hours a day, 5 days a week. And that trading window and the precise scalability of the instrument as the account grows is what makes this so attractive. And we explain those mechanics in full in Module 3 coming up, including the specific risk management rules that we apply and how the position sizing evolves as the account grows. But I want to be clear about what these are. These are choices made for one specific implementation of the system. They're not requirements of the framework. If you prefer stock trading, or options income strategies, or foreign exchange, or something else entirely, the income engine role can be filled by any of them. The target, reliable monthly cash flow, is what the system requires. The method you use to produce it is yours to determine, ideally in close collaboration with a mentor whose approach you've evaluated carefully and whose results you can verify over time. And this is where the virtual investing organization model, which we'll cover in Module 2, becomes important. The mentor you choose for your income engine will largely determine the specific method you use. A good mentor teaches you a repeatable system built around the instrument that they specialize in. By selecting a mentor whose style, schedule, and approach fit your situation, you are in effect self-selecting into a particular income engine method. And that, by the way, is a feature, not a limitation. It means your approach is grounded in proven practice and not assembled from fragments of different systems that may not work well together. And that insight runs through every approach, regardless of the instrument. You are not trying to get rich from any single trade. You are building a consistent process that generates income month after month with controlled risk on every position, and then letting the system compound that income into something significant over time. Now, the second engine is the growth engine. Its job is to take the income produced by the first engine and compound it systematically into a growing capital base. Compounding is a concept most people understand in principle, but they underestimate it in practice. And the reason it's underestimated is that its effects are back-weighted. In the early months and years, compounding produces modest absolute results. It's only later, when the base has grown large enough, that the percentage translates into numbers that genuinely change the picture. This means that the critical discipline in the growth engine is not finding the highest possible return. It's maintaining a consistent positive return over a long period of time without a catastrophic loss that resets the base. A loss doesn't just cost you the money that's gone. It costs you the compounding that money would have generated if it had stayed. A 30% drawdown doesn't just mean you need 30% gain to get it back. It means you need a 43% gain because you're working from a smaller base. The mathematics of loss are asymmetric and unforgiving. The growth engine is designed with this in mind. The priority is durability, not maximization. What does the growth engine look like in practice? Well, again, the defining characteristic is the outcome. Systematic, consistent compounding of the capital base, not the specific instrument. For some investors, the growth engine will be built around structured option strategies. The wheel strategy, selling cash-secured puts on stocks you'd be willing to own, and then selling covered calls once assigned, That's one well-established approach that generates consistent monthly income on a capital base while keeping risk manageable. Value investing is another growth engine approach, identifying quality businesses, trading below their intrinsic value, building a position over time, and holding as the market eventually recognizes that value. Dividend growth investing, building a portfolio of quality companies that pay and grow their dividends, is another. Real estate investment trusts can serve this function as well for some investors. The common thread is systematic. These are not speculative positions taken on a hunch. They are structured, repeatable approaches with defined entry criteria, defined holding strategies, and defined exit or rotation rules. The growth engine runs like a well-managed business, not like a slot machine. In the $1 Million Experiment, our primary growth engine vehicle is the wheel strategy, applied to high-quality companies with liquid options markets. We target a conservative 1.5% monthly return on the growth engine capital base. Now, we chose this approach because it is systematic, because the mechanics are learnable, and because it performs across a wide range of market conditions, including downturns, where the ongoing income engine cash allows us to dollar cost average into positions that the market is offering at a discount. Now, that last point is worth dwelling on for a moment because it illustrates how the two engines work together. When markets fall, a pure buy and hold investor simply watches their portfolio shrink and then waits. But an investor running the three-engine system has a different experience. The income engine keeps generating cash regardless of market direction. Futures and options strategies can be profitable in down markets as easily as up markets. That ongoing cash flow gets fed into the growth engine, where falling prices mean more shares of quality companies are acquired at lower cost. And then when the market recovers, those additional shares recover with it. The system turns market volatility from a threat into an advantage. And again, the wheel strategy and the 1.5% monthly target are our choices for our implementation. Your growth engine might look quite different. You might use a dividend growth strategy, or a rules-based value investing approach, or a structured income strategy built around a different set of instruments entirely. What the system requires from the growth engine is consistent, durable compounding with a capital preservation mindset. The method that achieves that, in a way that suits your skills, your risk tolerance, and the mentors you work with, that's the right one for you. The system does not particularly care how you compound, it cares that you do it. Now, the third engine is the accumulation engine. Its job is different from the other two in a fundamental way. Where the income engine targets reliability and the growth engine targets consistency, the accumulation engine targets asymmetry. Asymmetric returns are returns where the upside potential significantly exceeds the downside risk. You're not looking for investments that go up reliably by a small amount every month. What you are looking for are investments where the right thesis playing out over a multi-year period could produce returns of 5 times, 10 times, or more, while limiting the downside to the amount you initially invested. The accumulation engine is where you make venture capital style allocations. And you make them to opportunities that most conventional investors may not participate in because the time horizon is long, or the uncertainty is high, or the asset class might be unfamiliar. The venture capital industry has understood this logic for decades. A VC fund does not expect every investment to succeed. What it expects is a distribution. A few big winners that generate the bulk of the returns, some that break even or produce modest gains, and some that go to zero. The portfolio is structured so that the winners more than compensate for the losers. The key disciplines are consistent position sizing, the same dollar amount per investment regardless of the conviction level, and thesis clarity, meaning you have a specific, articulable reason for making each bet that you can revisit over time. What the accumulation engine looks like in practice varies enormously by investor. Emerging technology sectors, cryptocurrency ecosystems, commodities tied to structural demand shifts, early stage sectors undergoing regulatory change, any of these can serve as accumulation engine territory. If the thesis is sound and the sizing is disciplined, it's fair game. Real estate in an emerging market, a basket of small cap companies in a disrupted industry, a macro position on a currency or commodity. There are many forms that this can take. In the $1 million experiment, our accumulation engine is focused on major technology trends where we have a multi-year thesis we can articulate clearly. We size each position with a consistent dollar amount, and we review this annually rather than monthly. These are not positions that we actively trade. And the accumulation engine is funded by a portion of the growth engine's returns, not by direct contributions from salary or from the income engine. This is intentional. The accumulation engine has the highest risk of the three, so it's the last in the funding sequence. And one more thing worth saying clearly, the accumulation engine is sized so that even if every position in it went to zero, the overall system, the income engine, the growth engine, and the trajectory of the $1 million experiment would continue without being materially impaired. The accumulation, in other words, is the bonus. It's not the foundation. Getting that sequencing right, foundation first, upside second, is one of the most important structural decisions in the system. So let's bring the three engines together and look at the complete picture. The income engine generates monthly cash flow through active market participation. That cash flow does two things. First, a portion is reinvested into the income engine itself, growing the account and allowing the position size, and therefore the monthly income, to scale over time. Second, a portion flows into the growth engine, feeding the compounding process. The growth engine takes that ongoing input, adds it to the existing capital base, and compounds it systematically, using whatever structured approach you've chosen. As the growth engine balance grows, a portion of its returns flow into the accumulation engine, funding the long horizon asymmetric bets. The accumulation engine holds these positions for years, not months. If and when a position performs well, then those returns feed back into the system, back into the income engine to increase trading scale, or into the growth engine to accelerate compounding, or into new accumulation engine positions. And notice three things about this structure. First, each engine has a different time horizon. The income engine operates on a monthly cycle. The growth engine compounds on a quarterly and annual basis. The accumulation engine is reviewed annually and holds positions for years. This means the system is never fully exposed to any single market condition at any single moment. A bad month for trading does not affect your long horizon accumulation positions. A correction in the growth engine's holdings is offset by the income engine continuing to generate cash that can be deployed at lower prices. Second, each engine has a different risk profile. The income engine, done with proper risk management, generates income through disciplined, defined risk approaches. The growth engine prioritizes durability and consistency over maximization. The accumulation engine accepts higher risk on a small portion of capital in exchange for asymmetric upside. The three risk profiles are deliberate and complementary. Aggressive where the potential reward justifies it, and conservative where capital preservation is paramount. Third, the system is self-reinforcing. As each engine performs, it generates resources that make the next engine more effective. More income engine output means more fuel for growth. More growth engine return means more capital for accumulation. And over time, the absolute numbers compound in a way that a single engine approach simply cannot match. That is the three-engine wealth system, not a collection of investments sitting in separate accounts, each doing its own thing, but rather a system with defined roles, deliberate cash flow, and built-in resilience across different market conditions and different time horizons. Now, I want to leave you with one more thought before the next episode. A question I often hear at this stage is, which engine should I focus on first? The answer is always the same: the income engine. And not because the other two are less important in the long run, but because the income engine is what makes the other two possible at the pace the system is designed to operate. If you try to run the growth engine and the accumulation engine without a functioning income engine, you're back to the conventional model, contributing from salary, waiting for market growth, hoping the compounding math works out. The income engine is what changes the equation. It's where this begins. Now, the next two episodes go deeper on the income and growth engines respectively, what each one requires, what makes a good approach for each, and how to think about the choices you'll make in building your own implementation. If you want the full 5-year plan from the $1 Million Experiment, including the projected growth trajectory for each engine, the download is available at theinvestingproject.com. There's a link in the video description. It's free, and it will give you a concrete picture of what this system looks like fully assembled. Subscribe so you don't miss the next episode, and we'll see you there.